My name is Brandie Bland, and I am a board-certified patient advocate, a certified Alzheimer's caregiver, and a certified brain injury specialist. And I'm located here in Central Arkansas. I think the thing that people don't realize is their levels of income, assets, life insurance policies, annuities, all of these things that come into play for what we consider to be benefits approval, or how they actually qualify. So, for instance, for 2023 or 2022 into the first quarter of 2023, the maximum monthly income level for Medicaid is $2,523 per individual. Those kind of change if you've got a spouse. There's a little bit of allowances and things, especially if we have what's considered to be a surviving spouse. So if you have a husband and wife and one of them is inflicted with, say Alzheimer's disease and needs to be placed into a facility, Medicaid will make allowances for that surviving spouse who's remaining at home.
Oh, wow. Okay.
So giving them an allowance of sorts instead of seizing all of the institutionalized spouse's income. There are allowances that they will make so that the surviving spouse at home can continue to live, to pay for their utilities and their bills and the upkeep of their home and things of that nature. Right. So when we're looking at Medicaid qualifications, and let's just say we'll just throw out a scenario for Mr. Smith. So we'll just say Mr. Smith is a retired mechanic and has a small annuity. He gets a small 401k and he gets Social Security, and he's 75 years old. So what we would have to do in the application process for Medicaid is we have to prove 3 months of income. So we'll have to provide 3 months of bank statements, and that's any kind of banking institution. If you have a checking account, a savings account, a CD, an IRA, anything like that, we would have to provide 3 months, or the most recent 3 months. So if we were going to apply July 1, we would have to provide to them June, May, and April statements, because they want to see, exactly what income is coming in and what is going out, kind of an accounts payable, accounts receivable type chain, or any kind of savings account. If they have been, saving for, say, a grandchild's college. If they don't have that in a 529 college plan, that it would be exempt. If they've just sticking money back in a savings account and they're going to give it to little Johnny when he graduates from high school, that money is considered an asset. So the 5-year look back applies to any transaction, whether you are purchasing or dispersing of an asset. So if you have decided to, say, perhaps the couple has more than one vehicle. Maybe he had a vehicle and she had a vehicle, and the spouse that is having deteriorating health can no longer drive. They're going to give the vehicle to another family member, a daughter, a granddaughter, whatever. Or they sell it. Okay. Or they sell it on the open market. And let's just say they sold it for $5,000. And then a year or two, or sometime within the next 5 years, they apply for Medicaid. Those monies would be considered in on top of, let's just say the $5,000 was spent. They sold the car and they spent it on medical bills, or they went on a vacation or whatever. They would still be penalized the amount of the sale of that asset if it occurred within that 5-year period. So what Medicaid looks at is the amount of assets that person has. So if, let's just say you have $50,000 in assets, Medicaid could go ahead and improve you for Medicaid because they know that you're on what's considered to be Medicaid spend down, and you're going to be spending that money's down.
So we have this $5,000 for the car.
For the car, and they've got $50,000 in their savings account. That $5,000 is added on to that $50,000 level. So they would.
It's not tangible anymore.
Correct.
But it's added in the spend down. What does that look like?
So when Medicaid is making a payment on a claimant's behalf to the long-term nursing center, they would say the first $5,000 is the patient responsibility to settle that penalty period.
Okay.
So then the family members or the families would be responsible for paying up to whatever that amount was. So then they would kick in and they would begin to pay after that. You have to get under that $2,500 to about $2,000 level. They're not allowed to have more than $2,000 in liquid assets. They're allowed to have their house. They're allowed to have one vehicle and the land that is attached to the home. Those are all exempt. And then any other account that they would have, be checking, savings, annuity, IRA, whatever it would be, that could total no more than $2,000 for them to be eligible and for Medicaid to pay at 100%. And when they come to me, they're usually in crisis planning at that point. They're already at or very near the stage that their loved one needs additional help that they can't provide for them at home. Of course, in an ideal situation, I tell everyone, if you have the time and you've got longer than 5 years, of course, none of us know. I mean, when we're, none of us know what's going to happen tomorrow as far as our health is concerned. But if you have the luxury of time to pre-plan, I suggest that anyone who's getting near retirement age visits with either an elder estate planning attorney or a CPA maybe that focuses on, elder planning, something like that, so that they can kind of look at what you have and kind of give you that guidance. If you've got a savings account tucked away for a grandchild, make that specific. Make that specific for college, or go ahead and give that to the grandchild or put it in their name, or, do whatever it is that you've got to do to protect those funds from a potential spend down. Because there are what's considered to be Medicaid protected annuities available that certain elder care financial planning companies are able to kind of project and move and kind of make that. I almost think of it like a chess game. They make certain moves with a person's funds to get them into an annuity. So for instance, I had referred a couple to an elder estate planning firm who was able to protect all of their assets from Medicaid and still get that person, and they probably had in excess of $150,000. And they were able to move everything, liquidate everything out of their existing accounts, move that over into a Medicaid protected annuity, and then have that surviving spouse receive what they consider to be a allowance of sorts out of that annuity as a, kind of like a cost of living payment that was paid to the surviving spouse. They were able to stay at home. The other spouse was institutionalized on Medicaid, and the only thing that they had to surrender was the spouse's Social Security, because that is part of Medicaid. Medicaid will seize all of the all of the Social Security of the person being institutionalized, less the $40 personal allowance. Yes, so there is a what's called a Miller Income Trust account that is required if your income level is above the minimum, which is $2,523. If you are or if your incoming monthly income is above the 25-23, you could still qualify for Medicaid, but it is considered to be a spend down, and everything has to be placed in what's called a Miller Income Trust account. Not every bank does Miller Income Trusts, but there are several in our area that do. There is a trustee that is stated over the account, and then the person who is the holder of the account. So, say it's usually the patient that's inpatient. It's in their name with a trustee or fiduciary. I serve as a fiduciary for several of patients currently for those accounts. And what that does is it just gives an accounting to the state, to the Department of Human Services, that states that everything going into and coming out of that account is for this patient's care.
Okay.
So we can't go buy a car or go on a fancy vacation or anything with those monies. We're proving to the state that the monies that come into the Miller Income Trust are being paid for the care, whether it's to a long-term care facility, assisted living facility, at-home care, however it is, whatever it is that we're doing to care for that patient. That Miller Income Trust kind of safeguards that, and then that we have given an annual accounting to, as they review Medicaid every year, we have to give an annual accounting to DHS to prove just how that money has been spent.
No, and this obviously is after they've applied.
After they have applied.
Application.
Correct.
But
prior to, like I said, there are, and I'm not well versed on what that would be, where we would definitely want to. The safest thing is to have an irrevocable trust and to have everything placed into an irrevocable trust.
which I'm assuming they can't touch.
They cannot touch that,
And
but
this
it has
would
to be
where
done.
you would put
Everything.
grandbabies'
You would put
college
everything, the
funds.
house, the cars, every account, financial account that you have, everything would be under like the Thiebalali Irrevocable Trust. And so everything that you would have would be under that quote unquote umbrella.
Wow, that sounds like a situation that nobody knows about, really, ultimately. But
And that does require, estate planning, that
Like a
requires attorney
lawyer.
involvement. Absolutely. And there's other things people don't consider either when they're thinking about, I always like to say, think outside the box. So think outside the box when you're trying to determine what the right decisions are for your aging parents, for instance. And you're trying to come up with funds for personal care, whether it be CNAs coming into the home for home health, or whether you're looking at assisted living facilities or long-term care facilities. But there's things like reverse mortgages. People don't, you used to see the commercials on television all the time for reverse mortgages.
I think I see one with Magnum PI.
Yes.
He does a reverse mortgage.
Reverse mortgage. So that is, you have to be age 62 or older, and you have to have at least 50% equity in your home for that. Another thing is life insurance conversions. People don't think about life insurance. So if you've been paying on a life insurance policy for 30, 40, 50 years, and you are trying to qualify for Medicaid, you can't have life insurance policies, especially those that have a cash value. So what you can do is you can convert those.
Is it considered income then?
It is considered income because it has a cash value and you could cash that out. The other thing that you can also do is change the beneficiary. Medicaid, most of the time, will allow you to change the beneficiary on a life insurance policy if you have not done a prepaid burial or prepaid service plan with a funeral home. You can change the beneficiary of the life insurance policy to be the funeral home. If you think about it, if you have, just say for instance, a $10,000 life insurance policy, the cash value of that life insurance policy right now may only be $1,000 or $5,000 or whatever. It's probably not $10,000 that it would be payout at a payable upon death. So if you're trying to apply for Medicaid and you're going in to liquidate that policy to apply for Medicaid, you're telling the life insurance company that you no longer want the policy, and they're going to pay out the quote equity that you have in the policy. It may not be worth the $10,000. So if you want to continue the policy and have that full benefit of $10,000, that's when you can change the beneficiary to the funeral home.
Oh, that's
and then
nice.
you'll have $10,000 paid out upon death toward the funeral expenses, and you can do it that way. Otherwise, most people elect to cash out their life insurance policy if they have not done a prepaid burial. That is what we call that's a Medicaid spend down qualifying expense. So you can cash out your life insurance policy, and then you can go prepay for your burial expenses. They will allow that. They will also allow Medicaid, when we're talking about Medicaid spend down and you're cashing out these things and liquidating these accounts and trying to get under that minimum, you can pay for debt. So if you have credit card debt, medical bills are most definitely a Medicaid qualified spend down expense. And then anything that is for the care of the person. So let's just say your mother needed a shower chair, a wheelchair, ramps, something along those lines. You can spend down that money for that. Obviously paying for care, whether it be in-home care, institution care at a long-term care facility or an assisted living facility. All of that is Medicaid spend down eligible. The funny part, there are very few assisted living facilities in the state that accept Medicaid. Because the way that Medicaid works, one of the agents kind of explained it to me in a very simple way. They're allotted so many slots, which are beds. I call them beds, but they call them slots. They're allotted so many slots per state. So say Arkansas has 500 slots.
And when you say they're awarded, that assisted living facility?
The state as a whole is allotted a certain amount of Medicaid beds. Wow. Because you have to think about it. Medicaid is a state-funded entity that can't pay for everyone. So, there's a maximum. I mean, there is just the money will only go so far.
Right. We talked about that at the very beginning, and that's why they've got to do their due diligence and try to get as much of your income okay.
Exactly. So, if they're allotted 500 slots in the state of Arkansas, then those are dispersed. The individual facilities would then apply for whether or not they wanted to be a Medicaid facility. So they may have 5 beds, they may have 10 beds. It just depends, and it differs from facility to facility.
And why would they not? Is it because it's complicated?
It is very complicated. It is very, the business office managers in these facilities have to report to the Department of Human Services. Everything, they have to have a reapplication or a review every 6 months to a year. They review to make sure that there's been no change in that person's status, no change in that person's income, that they didn't get some windfall inheritance or, something didn't win the lottery or, something along those lines. So Medicaid beds are very, very hard to find in the state of Arkansas.
Yeah, see, that's good to get that information out, because I would have just assumed I would have assumed that these facilities would take anyone that was applying.
And, and in just in just the circle of life, there may be 5 beds available in a skilled nursing facility here in Little Rock, and they may have all 5, they may have them full with residents that are qualified, and then 1 or 2 may pass away. So there's always a rotation. There's always a rotation in these beds. or the person may be disqualified for, maybe they've received some additional income, or something that would make them ineligible. So there's all kinds of things that can happen that would free up an additional slot. But and I'm really not even sure if those how they determine the slots, and if that number of slots fluctuates from year to year. I don't know what the criteria is that the state uses to
Right.
distinguish the number of slots that are available in the state.
But when it comes to nursing homes, do they all take
Nursing
Medicaid?
homes, most of the time, depending upon the level of care and the type of home. So, what I would consider kind of our high end or our luxury skilled nursing, chances are they're going to have, they may have one Medicaid bed available, but they depend more on private pay individuals. And they cater to people who are, financially able to pay those premiums per month for their loved one to be there. So they typically do not, offer Medicaid beds. Medicaid beds are usually our average to lower skilled nursing facilities. And that's not to say that they don't get the same level of care. It's just that the amenities are different.